Credit card companies have one of the most profitable business models in global finance, but most people don't understand exactly how they make money. From interest and fees to massive transaction volumes and premium rewards, this industry extracts billions of dollars every year by monetizing both spending and borrowing in different ways. Let's start with the biggest players. In 2024, Visa reported roughly $35.9 billion in net revenues, while MasterCard generated about $28.2 billion. And American Express brought in nearly $66 billion in revenues, significantly higher due to its integrated network and premium card ecosystem. These results reflect not just processing billions of transactions, but also leveraging loyalty, data, and financial relationships in ways few other industries can. Even though these companies are often lumped together, their models differ. Visa and MasterCard act primarily as networks and processors. They don't issue credit themselves. Instead, they collect fees from banks and financial institutions for every transaction they authorize and settle worldwide. These swipe or interchange fees typically range roughly between 1.4% and 2.6% of a purchase value, depending on card type and merchant category. American Express, by contrast, is both a network and an issuer. This three-party model means Amex earns merchant discount fees, often higher than its competitors, plus interest and annual fees directly from cardholders. American Express's strategy has long focused on affluent consumers and premium rewards programs, which helps drive higher spending and revenue. Across the industry, interest income is the largest and most predictable source of profit for card issuers. Interest on revolving balances, where consumers carry a balance from month to month, often makes up roughly 80% of issuer profitability. That's because credit card interest rates are among the highest in consumer lending, typically above 20%, and the interest compounds quickly when individuals don't pay in full each month. But issuers don't rely solely on interest. They also charge a wide range of fees: annual fees, late payment fees, over-limit fees, cash advance fees, and foreign transaction fees. Even if a user pays their balance in full each billing cycle, issuers still profit from annual and usage fees, and they still collect part of the interchange revenue from merchants. Credit card spending overall remains central to the U.S. economy and to these companies' success. Credit cards account for about 31% of all payment transactions in the United States, with total payment volume continuing to grow year over year. That scale means every purchase, from groceries to travel, generates fee revenue somewhere in the ecosystem. Another revenue driver is rewards programs. Companies like Chase, Citi, and American Express spend tens of billions each year on points, miles, and cashback incentives. On the surface, this looks like free money for cardholders, but it's actually structured so that rewards encourage more spending, which in turn generates more interchange and interest revenue. These programs are often funded, at least in part, by the fees merchants pay every time a reward card is used. Despite massive profitability, the industry faces political and regulatory scrutiny, particularly over high interest rates. Proposals to cap credit card interest, for example at 10%, have surfaced in U.S. policy debates, with some research suggesting consumers could save $48 to $100 billion annually under such caps. Proponents argue that even with lower interest ceilings, issuers could remain profitable due to interchange fees, which are not tied to interest at all. One real-world example: Capital One Financial's credit card business recently generated over $12 billion in net interest income, contributing to quarterly profits above $2 billion. Their performance reflects how interest-driven lending remains a backbone of the credit card issuer model. So when we talk about how credit card companies make money, it's valuable to separate the layers. Networks like Visa and MasterCard make revenue by authorizing and processing transactions at massive scale. Issuers like Chase, American Express, and Capital One make revenue through interest, fees, and annual charges. Rewards programs and loyalty incentives are engineered not just to benefit consumers, but to increase spending behavior that feeds all of these revenue streams. Understanding this architecture helps consumers see why credit cards can be dangerous if misused, but also why they remain integral to modern financial systems and massive profit engines for financial institutions. If this breakdown helped you understand how credit card companies really make money and how the system is designed, follow Real Business Today for clear, no-fluff explanations of finance, markets, and corporate power.